Welcome back to the Explainer series, everyone. We're on Lesson 10 today, and we are shifting gears in a pretty major way. Up until now, our focus has been heavily tilted toward price, right? We've been looking at finding those exact order blocks, spotting hidden gaps, and mapping out structural breaks. But today, we're uncovering the massive difference between trading price versus trading time. We're diving deep into Chronos and Capital, mastering Killzone volatility and market narrative. We're actually going to test the exact time windows that big players use just to see if timing is truly as important as price when it comes to executing successful trades. Look, we have all felt this exact pain. I mean, you do your analysis, you find this absolutely textbook setup, you click buy or sell with total confidence, and then literally nothing happens. You're just sitting there waiting in a completely dead market. You watch the candle flicker up a pip, down a pip, and you're just wondering why your perfect setup isn't moving an inch. It's incredibly frustrating. It completely drains your mental capital. And honestly, it makes you second guess your whole strategy. But here's the truth. Your analysis of price, it might have been completely spot on. You were just entirely wrong about the time. See, most retail traders focus obsessively on where to trade. They spend hours charting order blocks, fair value gaps, market structure, the whole shebang. But the real secret? It lies in knowing when to trade. We're talking timing, session volatility, and algorithmic expansion. Knowing exactly when the algorithm is ready to inject volatility into the market is the absolute key to avoiding sideways chop. You really don't need to be glued to your screen 24 hours a day. You just need to be there when the algorithm is actually ready to move. All right, moving into section 1, the compass, building the market narrative. Before we even glance at a clock to find a kill zone, we have to establish our market narrative. Because honestly, algorithmic timing without a directional narrative is just pure noise. In our testing, we've defined this narrative as the literal story the market is telling us. It's built from two vital pieces of information. First, what the daily chart is currently doing, and second, exactly where the current trading range is sitting. If you try to jump into a volatile time window without knowing the story, you're essentially just gambling. So how do we uncover the story the market has already written? Well, we follow a simple, systematic approach that we call the 3Bs formula. It breaks down into 3 distinct steps: framework, draw on liquidity, and dealing range. By testing these 3 components together, we can systematically figure out our trading direction and anticipate exactly which way the upcoming session expansion is likely to go. Let's walk through these one by one. First up is B1, the framework. This step requires us to analyze the recent framework of the market. We're specifically looking at the chart and asking one crucial question. Did the market just tap a major point of interest, or POI, to initiate a move? We need to know if price has recently interacted with a significant level that would actually trigger a reaction from the underlying algorithm. If there's no major tap, well, the framework isn't set yet. Okay, once we confirm that framework, we move to step 2. B2, the draw on liquidity. Based on that recent tap of a major point of interest, where is the fuel the market wants to hit next? You know, the market is like a massive engine, and it needs fuel to run. That fuel comes in the form of liquidity. So we need to spot exactly where the retail trader's stop losses are sitting, usually above old highs or below old lows. Identifying this draw tells us exactly where the algorithm is ultimately heading. And finally, step 3, our B3. This establishes our current dealing range. Are we currently in a premium zone or a discount zone? It's pretty straightforward. If we're in a premium zone, the asset is overpriced, and the algorithm is going to be seeking shorts. If we're in a discount zone, the asset is underpriced, and the algorithm is seeking longs. When you combine the framework, the draw on liquidity, and the dealing range, you've essentially built an unbreakable directional compass. Which brings us to section 2, the map, trading the kill zones. Let's see how our compass helps us pinpoint these temporal entries. Here is the crucial point. Almost every major trend-setting expansion happens sequentially inside 4 specific New York time blocks. We're looking at the Asian range, followed by the London Killzone, then the New York Killzone, and finally the London close. Our data clearly shows that outside of these windows, the market behaves very, very differently. During our test cases, we found that the London session often creates the actual high or low of the entire day, while the New York session frequently provides a secondary entry or sharp reversal based on major news events. But what happens between those highly volatile kill zones? Well, we get dead zones. These are periods of sideways, chalky market movement. And what the algorithm is doing here is highly intentional. It is creating internal liquidity. It moves sideways to trap impatient retail traders who are trying to force trades when they really shouldn't be. If you force a trade in one of these dead zones, you literally become that internal liquidity. You become the market fuel that gets hunted down the absolute second the next kill zone opens. Let's move on to Section 3, God Level Tracking, the CBDR. We're going to elevate our tracking here. So, what is the Central Bank Dealer Range, or CBDR? It's a critical, preset price range that gets established between 2 p.m. and 8 p.m. New York time. You can think of the CBDR as a preset map that big players and institutions use to calculate their next massive moves for the upcoming day. It's a very quiet period on the charts, but the data created here is incredibly loud if you know how to listen to it. Here's where it gets amazing. By taking that specific CBDR base range and projecting it using standard deviations on your Fibonacci tool, you unlock an incredible edge. Our recent trade analysis shows that you can often pinpoint the exact high or low of the next day using this method. Very often, especially during major news events, price will rally perfectly to the second or fourth standard deviation of the CBDR and then completely reverse once the kill zone narrative has been fulfilled. It is truly like reading the market's hidden code. All right, Section 4, Dodging the Traps, 3328, and the Judas Swing. We know the algorithm is incredibly deceptive, right? It is literally designed to take your money. So the first test case we want to highlight to protect yourself is what we call the 3328 entry. This setup happens in the quiet, low-volume period between 3:30 p.m. and 8 p.m. During this window, the market quietly builds a tiny point of interest. Retail traders largely ignore it. But in our testing, this perfectly demonstrates how the market traps people. It builds this setup in the afternoon just to execute it violently the very second the Asian session begins, leaving everyone else scrambling to catch up to a move that was orchestrated hours ago. And then, of course, we have the notorious Judas Swing. This is a massive fake spike in price that happens at the very start of a session, most famously right at the London Open. This trap is specifically engineered by the algorithm to make eager retail traders buy or sell in the completely wrong direction right at the opening bell. It spikes hard, grabs the liquidity of everyone who bought the breakout, and then sharply reverses right into the true trend for the rest of the day. So how do we actually protect our capital? Well, the formula for the safe entry is crucial here. To avoid becoming market fuel, you must sit on your hands and wait patiently for that Judas swing to finish its fake out. Once it finally exhausts itself, you wait for price to tap a higher time frame point of interest, and only then should you pull out your optimal trade entry or OTE tool to find your execution level. By just waiting out the trap, your entry becomes infinitely safer and perfectly aligned with the actual algorithmic draw. Let's wrap it all up in Section 5, the final verdict. Bringing all of our data, our compass, and our map together, does the Killzone and narrative test actually pass? Yes, it absolutely does. But there is one massive caveat. Timing is everything, but only if your daily bias is correct. A Killzone without a narrative is just noise. Trading during the London or New York Killzones works incredibly well, for sure, but only when you unify your 3B's compass with your temporal map. Without that direction, jumping into a high volatility time window is literally just a recipe for disaster. So, what are your next steps to actually put this into practice? First off, you need to set up your charts to track these specific times. You can grab the session and CBDR settings guide directly from our app. It has all the exact indicator settings and the specific standard deviation levels for your Fibonacci tool that we've been talking about today. Second, make sure you're fully prepared for Lesson 11. That's going to be the ultimate unified algorithm test, where we take everything we've learned, structure, bias, and timing, and combine it into one unstoppable strategy. As we close out this explainer, I want to leave you with one final provocative thought. Will you stay market fuel, or will you trade when the algorithm is ready? Are you going to keep trading blindly in the dead zones, just getting chopped up by internal liquidity hunts? Or are you finally ready to sync your entries with the true algorithmic clock? That choice ultimately dictates your capital. Thank you so much for joining me to unpack this material today, and I will see you in the next explainer.